Hi everyone, and welcome to my weekly update on the NZSX 50. Before I jump across and share my screen, I have to do the housekeeping, and that is letting you know that this is for educational purposes only. It is certainly not intended for any personalised financial advice. If you're looking for personalised advice, you do need to go and speak to your own financial advisor. So let's take a look. Right here, you can see I've got the main board, the NZSX 50, up on the screen. Before I go any further, I know that there are a lot more shares that trade on the New Zealand market. However, in my experience with doing share trading, share investing, it's my experience that I tend to have better liquidity and better returns actually in sticking with the shares that are on the main indices. Like I just said, there are a lot more available. However, I have found that some of them do not have enough liquidity. And what I mean there is when I want to sell out, which is usually when a share price has fallen down to a predetermined figure where I have my stop losses, I want to be able to get out. And I've had several experiences where I've had profitable shares that have moved down and then ended up becoming losses because of that very reason. So I've learned now that for me, and I've been doing this for a number of years, that sticking just with the main board, the main shares that are in the indices, which as it says is roughly 50, sometimes there's 49, sometimes there's 51. With sticking with those, I tend to have a lot more success. And it also helps me with evaluating and comparing where a share is trading in relation to the main board, because if you've been a regular follower of mine, then you'll see that I like to see that an individual share is performing better than the main board, because then it means that's obviously driving the main indices if that's what's happening. So anyway, back to the task at hand. So I've got the main board up here, and I've just got this over a 2-year period. Again, this last week we have seen a second week in a row of a negative. Now that can sometimes happen because if you followed last week, you can see that we were trading up around sort of highs that we haven't seen for about 3 years. And so that can be quite normal, although looking here, because I've just started recording this on Monday, and you can see that the market has opened with a little bit of a negative as well. And no surprises there. But it looks like we sort of are at that line of resistance, of support resistance underneath. And yeah, that can happen when we've had a fairly strong run, which is what we've seen. You know, we've seen a low back in March last year, and whilst it hasn't been an absolute straight line up, we've certainly seen some pretty strong performance, which is great. Let's just put our indicators on and just see where things are looking in relation to that. 30 extra on, and you can see, yes, we're trading above that. No surprises that it is coming back to it a little bit, because that does tend to happen. We will also put on the 15 as well. It tends to happen when shares or the indices have run fairly strongly, and obviously that is what we've seen. So we're still trading above both of those. Could be that this 15-week moving average is about to cross through the 30, something we'll just keep an eye on. And because of this very reason, we've had 2 negative weeks in a row. It immediately is a red flag for me not to look any further. Hey, it could mean that we're just going to have 2 weeks and then we're going to start a run up again. I'm not into preempting markets. My rules say that if we have 2 consecutive weeks of negative performance in the market or in an individual share, then that's it. I don't carry on any further, because there will always be opportunities. I don't have to look for an opportunity every single week for a buying opportunity. The thing too that we need to look at is down here last week or the week before, we had quite a bit of volume in the sell-off, which is something to keep an eye on. And then last week as well, the volume was quite strong. So again, we need to watch that. If you're someone that likes to look at the indicators that I've got here, I don't tend to put a lot of emphasis on it, but the MACD, moving average convergence, divergence. So it means we've got the moving averages, we've also got the volume all on one chart. And it does look like that we could be starting to see the market turn, especially if we were relying just on the MACD. So again, the volume, if you like, we started seeing those negatives, that's trailing off, where the moving averages are looking like they're going to cross on that MACD signal. So again, that's not something that I would want to be launching into. I would rather err on the side of caution and just wait and see what else does transpire. Because like I just said earlier, there will always be opportunities. Just take it out to the 5-year mark and we'll just have a quick look there. Makes us see the screen a lot easier. So basically, we had a high back in January 2021, and the market, it's obviously been moving its way up there quite slowly, but hey, at least it's heading back to that high. Like a lot of markets, and come and watch Thursday as well. I'm going to review Kiwi Property Group, another property sector, but I spoke about this as well on the Kiwi Property Group, and this is what happened for a lot of shares, most and indices all around the world during COVID. We saw a really sharp sell-off really quickly, basically 2 to 3 weeks, and the market had gone from highs down to obviously lows. And our main board here is no different. Kiwi Property, which you'll look at on Thursday, is also the same. So I'm going to stop that. I really hope you're getting some value out of it. I'm loving the comments that you give me, the feedback. If you want to learn more, then let me know, and I'm happy to do a recording and hopefully teach you, like I just said, the methodologies I use, and then it can hopefully kickstart you into having a go into the share market as well. And please remember, I've also got the share trading signal service, which every week I send out updates as to any stop losses that I have moved on my shares, any purchases that I'm looking to make, and also any exits. And this, again, it's not advice, it's the methodology I use. And for a lot of people, they find it can be a very good stepping stone as to just do it, then further doing research on the shares that they want to perhaps have an interest in. Some people like to follow it as I send them out, and that's entirely up to you, but you're welcome to jump across there. Like I just said, a lot of people are getting value out of this, and it's free for the first 30 days, so I'd love to see what you think. Okay, until next week, take care.